so at the outset, I think very warm welcome to each one of the delegates here, and a very, very big round of congratulations to the organizing committee of the IFA Galaxy. It's very good to see such a big audience, fantastic energy here, and thank you for having me over. So thank you very much. Okay, so I think we had the previous speaker, Karan. We also had, we have a panel discussion after this, and coincidentally in both these events or both these sessions, one of the things that was discussed was asset allocation. And somehow I have got sandwiched in between talking about asset allocation. So I think it's a very relevant topic in today's market when the markets are really, really zooming. And my brief session would be a repetition of some basics that I think all of us need to be keeping in mind when we are advising our clients, because end of the day, what is good for the clients is good for us. And as Karan mentioned, that we are here for the long term, and one of the most basic fundamentals of investments in long term is asset allocation. So just a brief roundup of the various investment opportunities that an asset allocation has. We have deliberately kept crypto as well. You guys must be a little wondering why crypto is mentioned. Crypto is mentioned simply because, customers talk about crypto. We may not like crypto as an option because there are so many question marks around crypto, but crypto is mentioned because the customers were at least till about a year back talking about crypto, but I think nowadays it's faded off a little bit. So we have equity, we have commodities, we have debt, we have cash equivalent, and real estate as the broad asset categories in one which an investor can sort of invest. Why do we need asset allocation? What is the basic requirement that we need to have asset allocation? Asset allocation is required because all these asset categories sort of rotate over a period of time in terms of which is the asset category which is performing well. So there has to be an asset allocation of the portfolio so that we are catching different asset classes as they move up and down in terms of the return spectrum. So if you just take a 1 year allocation, 1 year returns of various asset classes, comparing it with CPI, various financial assets, that is, we will see that equity over the last 12 years has been on top with about 7 times in terms of best performing category. Gold has performed about 4 times, and we've got the inflation beating all asset categories, debt, equity, gold, once over the last 12 years. So there is a definite case for asset allocation because we have different asset categories, sort of rotating in terms of their performance over a 1 year basis, over a 2 year basis, and even over a 5 year or a 10 year basis. Apart from the assets, apart from the financial assets, markets also rotate. We have the different markets here, and surprisingly, or not so surprisingly, over the last 12 years, India has been the best performing country in terms of economy for the last 5 years. Out of the last 12 years, India has outperformed US, Europe, China, Asia as the best, and Europe as the best performing economy 5 times. So the India story is very real. The data shows it, and we need to stay invested in this economy for creating wealth for ourselves as well as our clients. Another category, we have different categories, and within equity we have the large cap, mid cap, small cap. Everybody talks about large, mid, small, which is running away, which is shying away, which will run away now for the next 6 months or 1 year. So we have the various categories also rotating. So we have the same period of about 12 years. We have the mid caps, or we have the small caps performing best in the various categories of large, mid, and small 5 times over the last 12 years. The large cap thrice, mid cap 4 times. So we've got all the market capitalizations relatively, performing better than the other category over a period of the last 12 years. And it is important, it is again a case in point to ensure that we have a proper asset allocation for our investors to generate long-term wealth. Just an illustrative example of what an asset allocated portfolio can look like. You have stocks, you have bonds, you have REITs, you have commodities, you have cash. It's just an illustrative example. I'm sure all of you are familiar with this. Basically, the idea is that it's an optimal asset allocation sort of strikes a balance between the risk and rewards. So we need to take care of the risks that that portfolio is giving and the expected rewards that that risk-adjusted return can sort of give. That's the idea of an asset allocation. Within the stocks, within the stock allocation, again, there will be further asset allocations that you can do. You have the large caps, you have the mid cap, you have the large and mid, so multi-cap. So you have, SEBI has categorized so many, put the categorization into various compartments, airtight compartments, if I may say so. But all these categories are equally important for the investor to generate wealth, to generate good wealth, keeping in mind the return, the risks involved in that portfolio. There is broadly the three investment styles also which is there. We have the value style, we have the growth style, and we have the blend of both growth and value. That also could be a reason, could be one of the parameters for making your asset allocation choice. This is one slide that I would like each one of you to have a look at closely, because this is something which gives a clear, a very, very clear relationship between the value and the growth style. It's a very linear relationship wherein growth and value sort of alternate with each other. This is the data for the last 15 plus years. The yellow shaded line is that of the growth, is that of the value over, performing better than the growth style. The purple shaded areas is where the growths have performed better than the value style, and it is a clear opposite of each other. The time period when the growth style has outperformed value is exactly the opposite when the value style has outperformed growth. So these two styles have to be counterbalanced more or less to generate optimal wealth for the investors. How does an optimal asset allocation portfolio look like? You have to have diversity as well as discipline. Diversity in terms of sustaining growth and the ability to invest in higher rate of returns. You have to have a blend of growth and value styles. And the value style is essentially those where, companies that experience an improving trajectory bought at attractive valuation. So you look at valuations in the value style. Growth style purely looks at the growth stocks, which may not be cheap. You never had HDFC cheap, you never had Nestle cheap, you never had Titan cheap, but over a period of time, these are stocks that are multi-baggers, right? So that's the pure growth style, and a blend of both sort of creates a balance between the two. This is again just an illustrative example of what the product spectrum on risk versus return is. From the mutual fund perspective, we have the liquid category or the cash category, which is the lowest in terms of risk, but again, the lowest in terms of returns. The accrual, which is the long-term debt, which is in between debt, is little higher in terms of risk, giving it slightly higher returns, going right up to the sectoral funds, which is the highest in risks, but probably would look at highest returns over a long period of time. So the entire gamut of products, basis the risk, basis the returns, is available for the investors. One needs to take a prudent decision as to what a proper wealth allocation, or what a proper portfolio allocation should be, what a proper asset allocation should be across all these product categories, because all these product categories are important. They solve a specific purpose. The liquid category solves the purpose of providing emergency liquidity whenever on beck and call, whereas the sectoral or the small cap or the mid cap helps generate very, very long-term wealth. So all these product categories are equally important, and depending on the investor requirement, we need to ensure that we have a proper allocation of all these categories in their portfolio. So what could be a characteristic of a core portfolio? Core portfolio, which is the strategic portfolio around which you build the various other assets, is roughly about 40 to 60% of the particular investor, depending on the investor requirement, the investor's investment horizon, the age of the investor, the risk profile of the investor. So a core portfolio represents a substantial holding for achieving long-term financial goal. It wants to reduce the overall volatility of the portfolio. It will look towards generating long-term wealth, and around which the other asset classes sort of can be added up. So it is relatively easier in terms of, lesser in terms of volatility and downturns. That's the basis of a core portfolio that we need to first look at, and then sort of build on the other asset classes for our investors. So here we have currently in the markets, we have the dynamic asset allocation strategies. From UTI, we have two product categories. One is the balanced advantage category, and the other is the multi-asset category. Balanced is a product which has both debt and equity, whereas the multi-asset category, along with debt and equity, includes gold as part of the portfolio. This is a product. These two products help in asset allocation on an automatic basis for the client. Both these products are, independent of the fund manager's decision of when and how much to rebalance. It's driven purely by quantum. We have a model which determines the asset allocation, determines the equity allocation for both BAF as well as multi-asset allocation portfolios, and both these portfolios are sort of, par for course in today's volatile environment. We have also some passive offerings, smart beta offerings. These offerings have given phenomenal returns over the last 2 years, proving that the model that it works on has a lot of content in it. These are some offerings in the momentum space. There are some offerings in the low volatility space. So one can always look at these smart beta offerings, which UTI provides. So to the end of my presentation, I think the most important key to successful investing, especially in these volatile times, is asset allocation. There is no doubt about it, because asset allocation is something that will help in the long term to be very, very clearly focused. When you have so much of noise surrounding investments, when you have so much of volatility in the market, I think if you stick to basics like asset allocation, it will help in the long term to generate wealth for the customers. Asset allocation will ensure that you are not walking out from an asset category. There are a lot of talk that, small and mid cap have run up and we need to just exit small and mid cap. That's not what asset allocation says. What it says is that if you have thought that small and mid cap should be roughly 20-25% of the portfolio, and because of the run up, it has gone up to 30-35%, we need to rebalance that allocation and sort of get back into the portfolios where the asset allocation percentage has come down. So that's what asset allocation says. So it's a very, very level-headed way of thinking for creating wealth for the long term. And I think at the end, that's the perspective that we have. I think Karan made a very nice point. The MFD fraternity, when they look at a customer, they are looking at the customer for a long term. I think that's a very, very, very important fact of this community, because when they onboard a customer, all of you are looking at the customer for perpetuity, right? Maybe even more, maybe the second generation. And even for yours, I'm seeing a lot of second generation people joining the MFD business, which is looking at continuity, and that's long-term trust, right? So I think asset allocation is a very basic fundamental that we all need to practice, that we all need to look at for in terms of wealth creation for the long term, because it sort of cuts away the noise. It drives away the emotions from investing. So thank you very much for patiently listening to my presentation, and wish you all the best.